Good morning and welcome to you all. We're here today to hear from Mpac Group, who have today announced their full year results to the end of December. We are joined by Will Wilkins, CFO, and Tony Steele's CEO, who will kick off the presentation and then take Q&A at the end. Over to you, Tony.
Yeah, thanks, Hannah. Welcome, everybody, and really do appreciate you joining today to hear the continued story of Mpac. We thought we'd start with a short video which illustrates, first of all, our acquisition of Switchback, which happened in September of last year. But the short video, the reason for showing it is we shared it on social media shortly after it was launched as a new product, a compact, smaller unit for the craft brewing industry. And as a result of sharing it on social media, we picked up a number of inquiries in Europe, and that has led to orders. So it's an organic synergy, and I think that's a good place to start. So. So just to focus on what we think we achieved last year, I would say that Mpac proved to be resilient, adaptable, and our business model was stress tested, with the outcome being that we believe it's further reassurance of Mpac's future growth prospects. You know, last year, as we all know, was unprecedented times, and we at Mpac have demonstrated our resilience and acted with agility to adapt to the circumstances, and we have continued to provide customers with equipment and services that they need to maintain the essential supplies of healthcare and food and beverage during the pandemic. We took the approach to be on the front foot during the pandemic and to use the opportunity to not only maintain equipment and services to our customers, but to accelerate the deployment of our strategies, including the deployment of digital technologies, the continuation of the brand building, which you'll see during this presentation, the Mpac brand and marketing activities, focusing on new product development, deploying more resources to support our business systems upgrade to the new ERP systems, and not least the acquisition of a Switchback. And simultaneously to that, quick actions on cost control, cash preservation, to provide further reassurance about our ability to weather the pandemic. Obviously, when the pandemic started, we had no idea of the length and the depth of it, and we're still in it. So, you know, I think those things are all still very relevant and ongoing issues that, as the management team, we're dealing with. So all in all, we're proud of our colleagues and the progress that they made in the last year, and we're confident that we've put Mpac in pole position for a rapid return to our growth strategy as the unlocking process continues. So next slide, please. In terms of the full year summary, I'll just pick out some key points from my perspective. We'll have adequate chance later to go through the numbers in some detail, but you know, the first thing I would like to pick out on is the prior investment in the Americas. We saw a really strong performance last year in the Americas with a acquisition of new customers, more diverse order book, and the leveraging of that our position out there based on the investments we'd made 2 years prior, and then the investment of in the acquisition of Switchback in September, really positive for our long-term strategy. The ability of our commercial team to pivot and adapt to the essential markets as well was I think, one of the standouts of the year. What do I mean by that? Well, there were certain activities or certain customers who were more adversely affected by the pandemic, but our commercial team were able to pivot to more essential healthcare and food products. We saw a big upturn in things like popcorn, machinery, high value ice cream. Obviously, you can see from the craft beer in Switchback, we did well as well. I would also like to pick out on the service performance in 2020. Why? Because it was slightly ahead of the previous year, despite the pandemic and the restrictions to getting on site to do installation and commissioning work for new projects and traditional breakdown service. We saw an increase in additional equipment to, if you like, improve the utilization of existing equipment, and we saw an increase in spare parts usage, which supports the customer to ensure the equipment was available for longer at higher levels of performance. We mentioned already the Switchback, and I've got a slide on that later. The Switchback acquisition, we'll come back to that. And then the final point I bring out on the full year summary is the ERP rollout. We've rolled that system out now in Europe in Q4 of 2020. We've just gone live in Mississauga in the first month of 2021, and we'll go live in Tadcaster in April. It's gone remarkably smoothly. Why? Because there was an awful lot more time and preparation went in during the pandemic. We built up the team and we made sure we had enough understanding and resources to roll that out smoothly. Just a quick glance at some of the numbers there. And then we'll move on to the next slide. So I just wanted to pick out there that overall the financial numbers, and we'll talk about them, but a really robust order intake with a much more diverse customer base and ahead of the previous year, which is good. The revenue slightly down on the previous year. Most of that was in the first half, and we saw a return or an upsurge in the numbers in the second half, potentially down to pent-up demand following the first lockdown. The PBT, really pleasing to see a number 6.3. Why? Because that shows a sustainable turnaround now. If you go back 2 years prior, 3 years prior, we were still in the process of turning around the Mpac business, and now we've got it to a level where we believe it's sustainable and we can kick on to the next level. And a tremendous job on cash last year, even though we spent from our cash reserves on the Switchback acquisition. Next slide, please. In terms of overview, who we are, I think it's pretty clear. We're a global provider of full line packaging and automation solutions. We're an equipment supplier. We supply the equipment that our customers use to package their products for future distribution. In terms of what we do, I've got a demonstration here in front of me, a bit of show and tell. I have to put it in the right part of the screen. You can see it. So this is a carton of actually healthcare wound care devices. And if I open the package up and show you the contents, we see inside this is a wound care patch. You see it's a woven product there, which we can make on our equipment in our Tadcaster facility. That's the internal contents. It's then packaged in a plastic sachet with the brand marking on it. So we do that also within our Tadcaster facility. And then when we come, that's primary packaging, just to explain that. And then when we come to secondary packaging, you can see that these are usually collected together as a I'll put it in the right part of the screen, as a package like that. And the secondary packaging is putting those primary products into a carton. And it's not so easy as I'm making it look there when you're doing that at 600 per minute. That's termed secondary packaging, putting that into the carton, which is quite complex because there's also a leaflet in there. And then end of line case packing is putting those cartons together into a packing case that are then left to the distribution company to take on to the retail outlets or the hospitals in this case. So hopefully that gives you an idea of what we mean by primary packaging. That's the woven wound care products put into the plastic sachet. Secondary packaging is the cartoner, and then end of line is putting that into a case. Our main focus, just to finish off on that slide, continues to be healthcare and food and beverage. And the way we differentiate in the marketplace is through innovation, flexibility, and our service proposition. Next slide, please. This slide really represents, a milestone, an important milestone in the Mpac journey. We relaunched, or we changed our customer proposition in the year to become Mpac Automation Ecosystems. And hopefully in this slide, I can explain a little bit by what we mean there. So the first thing is whole lines. So we offer customers now whole solutions, as I just demonstrated there, from primary packaging right through to the end of line. Whole life, that alludes to the fact that we'll help the customer to look after their equipment for the whole life of the equipment. So all the service needs, the upgrades, the reconfigurations over the period of time. And more importantly, the coming the industry 4.0 features, so that they can maintain by monitoring the equipment for the duration and get the optimum uptime and minimize downtime for service and changeover parts. And then the whole planet. This is a part of our sustainability drive with our customers to make sure that we're helping our customers to ensure that they minimize waste, reduce their carbon footprint, and also help to make the equipment the least cost investment over the time of the period. So, and as all ecosystems, they have to be sustainable. So we, with our new market approach of whole line, whole life, whole planet, we're looking to really differentiate in our marketplace to offer a full package to our customers. Next slide, please. Where we operate, the change here from previous years is that we've now got our USA facility. As part of the Switchback acquisition, we've now got premises in Cleveland, Ohio, Richfield. And the plan this year is to extend that premises. We know when we bought the company that they were on a high growth, 20% compound average, and we do need to expand the facility. But more importantly, that'll become a USA hub for Mpac for all products and services. So we'll have a sales and service hub there for the rest of our businesses. And the other change that's in our notes is we integrated the business activities of Coventry into the Tadcaster facility during 2020. And that's important for what reasons? Well, for momentum and scale. When we bought the Tadcaster facility, we knew that we ultimately wanted to integrate those business activities. We talked to our key customers. They were very supportive. We worked together to identify the key talent and make sure that we retained the key talent. But we've now got all the business in under the one roof, as it were, in Tadcaster, which gives momentum, which gives scale, and really enhances our customer proposition to take on larger, more complex projects. Next slide, please. Our business model, we've refined this over the last 12 months in terms of how we see it as as part of our whole line, whole life ecosystem, automation ecosystem. When we look at the split at the moment there, we can see that our business is something like 65% in design and build and 20% or so in optimize. Where we see real growth in the business is in the monitoring section there, which is the Industry 4.0 play. All our equipment now is able to gather data during the production process. And we offer now our customers modules to be able to analyze that data, to use that data in real time to improve the performance of their production process, and to give them productivity insights as to where they can improve their process, reduce waste, and increase their uptime. So that's the area where we see we can grow in the future. But overall, we offer the customers each one of those areas around the outside of that circle. And it's a part of our proposition now, our go-to-market strategy for the Mpac systems. Next slide, please. This is a busy slide, but we really make no apologies for that. It was a busy year, and we needed to focus on many different aspects of the business. And as I said before, be on the front foot during the COVID pandemic to make sure we're making really good use of the time and simultaneously maintaining the business with our customers. the highlights I'd pull out of that, the first one is the acquisition of Switchback, which is in our going for growth strategy. And we have a slide on the integration of that coming shortly, so I won't dwell too long on that. The second one is the full line solutions under innovation for 2020. I think that was really important, and we have a case study to support that. This is about being responsive to customer needs and our innovation skills. We were able to launch a new product within the year and gain orders, which I'll talk to, and it's a testimony to our team in Tadcaster, how they were able to take that from a concept to develop it using 3D technologies, virtual reality, and win an order within 6 months, and we're in the process of building that equipment now. The pivot on service, which I think I talked to earlier, the results for 2020 for service were better than 19. 19 was a breakout year when we improved the service revenues quite significantly, and we managed to maintain that in 20 with the headwind of COVID and the restrictions on travel and attending customer site. So I think that really stands us in good stead for the future, to build that as a further platform in the growth of service. The ERP rollout I've already talked about, but overall it's the responsiveness of our colleagues, the retention of the talent, and the development of the talent across the business, and the way they were able to step up during the challenging times, but not only step up and ensure we were COVID secure, but to pivot to different activities to accelerate our strategic agenda. If I move to 2021, which is a lower part of the slide, and what are our ambitions? Launching Switchback in Europe, and you saw the video earlier, that's already had an impact. The Switchback customer base tends to be more small companies, more entrepreneurial owners, so the use of social media has really improved things for us. That was one of our focuses last year. We've had a 40% uptick in social media followers based on our redoing our websites and putting more resources into the social media platforms. The service business in the USA, as I mentioned, we're looking to move facilities. We've already got the facilities under refurbishment in Cleveland, Ohio. They're twice the size of the current facilities, and we want to make that a USA hub for all our products. I just mentioned the facilities move. I think that's an important milestone for the Switchback business, and that's going according to schedule at the moment. Leveraging further the digital technologies, and I think we've got some real advantages we had over our competitors in the last 12 months, because we were well prepared in advance with a very well thought through IT infrastructure, and we had video conference facilities prior to the pandemic, which we could seamlessly move towards during the pandemic and improve our customer connections and overall marketing approach. And then in terms of future plans on the employees, to further develop our talent across the business using what we're calling the Mpac Academy. We've got some fantastic apprentice programs working in our businesses. We've got in other businesses really excellent graduate training facilities. And what a compelling proposition for a new graduate to be able to join a group and potentially work in Canada, the USA, the Netherlands, the UK, and get all that cross-functional training around the industry. So that's one of our key focuses in 2021. Next slide, please. The addressable markets, I think those of you who are following the Mpac story may have seen this slide before. We've updated it with the latest trade association numbers coming out of the PMMI in the Americas. The markets are still as big, very compelling markets for us to go for. We don't see any reason to stray really out of healthcare and food and beverage as our primary focuses. We do have some plays in pharmaceutical, which we will continue to follow. The mega trends continue. Maybe post-COVID, we will see a lower disposable income when we start having to pick up the bill for the economic impact of COVID. So there'll be a greater reliance on essential healthcare and food staples. We may see a lessening of things like premiumization, which was very much a European thing. But we've seen during the lockdown that premium ice cream has been a real growth sector for us. So I think the mega trends continue, and they've proven to be resilient end markets over the last 12 months. The PMMI just coincidentally did forecast a drop of around 15% globally in 2020 for the overall packaging equipment markets, and they expect to return to 2019 figures by the end of 2021, early 22, just to give a backdrop of how we're performing in the industry. Next slide, please. So here we're focusing on Switchback, the acquisition, and I think since the acquisition in September, we've been really delighted with the progress that Switchback have made. Their growth has continued, I think supported by the lockdowns in the USA. They're very, very much a USA play at this stage, and COVID has played to that with people consuming craft beers at home. But nevertheless, the order intake has been more or less double our expectations in the 5 months of ownership, and the revenues are building and improving month on month. So that's a fantastic backdrop. Strategically, it fits really well. It's a high growth company, very complementary products, but it broadens our customer base and gives a two-tier option to our customers, which is also very attractive. And I think the other thing I want to mention is the synergies are going really well. Quite often in these scenarios, the CEO, CFO is pushing synergies hard in the businesses, and it's quite a headwind internally. In this case, it's organic synergies are rolling themselves out. The team in the USA, our wider Mpac team, have really taken the product on straight away, and we've got synergies working already where we're cross-selling the Switchback range within a Langen solution, and that's fantastic. And as you heard from the video earlier, that the opportunities are starting to build in Europe, and we've already started to build product for European consumption. CE marking is something that we'll do in our Tadcaster facility in the short term. So it's a great business, and you can see from on the right hand side that the market potential for craft beer is substantial. The compound average growth rates are huge, and the European market is around 2/3 of the USA market. So we see plenty of headroom there to grow the business within Europe over the coming years. Next slide, please. So COVID-19 review, I think we're all a bit fed up with it now, so I won't go backwards and start talking about the things that we did at the time. I think they're all really understood. I think what we can talk about is really the legacy opportunities that have come from that. And it's been quite dramatic on the business. We now, for instance, do all our factory acceptance tests, which is where the customer comes to the premises and checks off the equipment before it's sent to their site for site acceptance testing. These are now all done remotely, all by video, and I don't think that will return. It saves the customer a lot of money and time, and the same for us. In terms of the website development, which we had planned anyway, we accelerated that. So we've renewed all our websites with the new customer proposition, Mpac automation ecosystems, and spent a lot of time on social media. And we can see that our followers have gone up 40%. And just to put that into reference, one of the big players in our industry, 10 times our size, has 20,000 followers, and we as Mpac have 14,000. So we've really pivoted quickly to that, and that helps with customer connection. I think something like LinkedIn is the go-to tool now for people to stay connected on an industry basis, and we're very much invested in that and using those opportunities. And the COVID-related space, we've developed a number of opportunities in that around things like, and you'll see in the case study, a COVID opportunity specifically, but things like healthcare, hygiene, diabetes testing. These areas have really been quite prominent over the last 12 months, and our commercial team has managed to pivot towards those. So all in all, I think we've handled COVID really well, and it's a credit to the leadership and all our colleagues across the business. Next slide, please. So this is the case study, and also the headline says COVID-19 test, which is the end product. But I think the real story from our point of view is our ability to innovate and the responsiveness of our business to be able to bring a solution. So bearing in mind that we said last year in our strategic objectives that we wanted to launch a full solution as we call it, primary, secondary and end-of-line case packing for the healthcare market using a platform or a modular technology. And our engineering team were able to create that in 3D, use virtual reality tools and augmented reality tools to demonstrate that to customers and gain enough, if you like, buy-in and support from the customer that that's turned into an order. And the order happens to be in the COVID testing space to do a complex assembly of a test device, which gives the benefits of the quality of a PRC testing, but with the time span of only 90 minutes. So it's more akin to the lateral flow test device. And the requirement of our end customer was speed and responsiveness to still be current during the pandemic. Mpac was chosen because of our previous experience in complex assembly, but because of the new product line and future-proofing the customer's investment. You know, the solution, you can see there the layout of the line, but the added advantage was using, again, digital technologies, a concept called digital twin technology, where you develop the product in a virtual world, almost complete, and you can develop the software in parallel to the machine design, and you can develop the commissioning plans so that when the product is actually built, an awful lot of the support infrastructure is there at the same time, and you can use that digital twin to, you know, to check the concept and make sure it works. So really leveraging all sorts of digital technologies to be more responsive and quicker lead time, which is the benefit to the customer ultimately. Next slide, please. So in terms of sustainability, we've been, you know, working hard on this, and it's part of our overall rebranding, as you can see with the, you know, with the Mpac automation ecosystems. The last 12 months, the war on plastic has been somewhat diverted because of the COVID situation, but it will come back on the agenda, and at Mpac, we're here to support our customers through that by partnering with them to achieve the sustainability goals together. Developing equipment to work with single-use plastics, reducing the use of single-use plastics, so to be more adaptable to product that's less conforming than single-use plastics, let's say, and to improve the lifespan of the equipment, so improving the efficiency, reducing the waste, all of that leading to smaller transportation footprints, remote support, smaller carton sizing. It's all about, for us, partnership with our customer. Our carbon footprint as a business is not so significant, but our customers are, and working with them to try and improve the sustainability, or for them to achieve their sustainability goals are our goals. On the right-hand side there, you can see that our leadership team and quite a few of our employees got involved in an exercise to create a purpose statement for Mpac going forward, so we can start to sort of build on that, and as it says there, to create automation ecosystems that enhance manufacturing to help businesses to adapt and grow. And that was co-created within the company, and it's something that our employees are really now starting to stand behind. With that, I'll pass you across to Will to go through the financial numbers, and then we'll come back for a short outlook summary. Will.
Okay, thank you, Tony. Do you want to go forward, Hannah? One more slide, please. Thank you. So I'll start with the highlights for 2020. I think the first highlight would be to say that we consider this to be a pretty solid year's performance financially. If we start with order intake, it was a strong second half of the year. Order intake rebounding in that period back to pre-pandemic levels, and resulting in full year order intake of 83.9 million. Regarding our original equipment part of the business separately, very strong second half of the year, driven predominantly by the Americas region, where we saw a good level of order intake from both new and existing customers across the food and beverage and healthcare sector. And to give some context to what that means in terms of quantum, original equipment order intake in the second half of the year was about 200% of the level of order intake in the first half of the year. So a really strong bounce back, releases some of that built up prospects within our pipeline from the first period of lockdown. And moving on to our recurring service element of the business, it held up well throughout 2020. That was order intake. And over the full year, order intake was slightly above the prior period. Looking on at revenue, so full year revenue of 83.7 million. Again, a strong second half of the year. On the following slide, we go into a bit more detail on revenue, so I'll skip past that for now. But this robust second half of the year helped to deliver a strong closing order book of 55.5 million, which is 6% above the previous year. Some comments on profitability. So gross margins remain broadly unchanged, which in itself we considered to be a noticeable success given the operational challenges, especially in the first half of 2020. So to be able to maintain that overall level of profitability was a considerable achievement, and that's been helped by a greater proportion of our overall revenue being generated by our service part of the business, which typically carries higher margins. And that collectively has helped to generate an underlying profit before tax of 6.3 million, underlying operating profit 6.5 million. And I think we consider this really demonstrates now that the business has made that step change to a new level of sustainable profitability. You can see on the chart on the right hand side the move we've made, and it gives us confidence that we're on track to deliver our longer term strategic initiatives and goals of a 10% return on sales. I'll make some comments on cash and cash generation. So Tony mentioned in his presentation that we implemented appropriate cash and profit preservation measures earlier in the year, and they helped to generate 11.2 million of operating cash flows that we're reporting. And it's those strong operating cash flows which have fueled the closing cash balance of 15.5 million, which is after funding the acquisition of Switchback and the ramp up of investment in business systems, investment and new product development. So a very strong closing cash position. So for OE revenue over the 5-year time horizon, we're running at about 22% compound average growth, and for services revenue about 12% compound average growth. And I mentioned before the step change in operating profit. So overall, these figures give us confidence that we're on track to meet our longer term objectives, and all in all a strong financial performance in the backdrop of 2020. If we go forward a slide, please, Hannah. So having a little bit more detail about the group income statement in 2020. And again, as with order intake, revenue and with OE started, in the second half of the year was particularly strong. So we're showing 20% half year to revenue growth for OE over the first half. That's 10% on a like-for-like basis. And we mentioned at the interim results that service revenue has been one of the big success stories in the first half. And that continues into the second half. Obviously, the mix and the dynamics changes with the strong OE revenue growth in the second half. But we are really pleased with the way the service business has performed. Again, it's testament to the ingenuity of our service teams to be able to find ways to develop business in the context and the backdrop of the ongoing travel restrictions. And that part of the business has been supported by strong performance on spare parts and additional equipment revenue. And overall, 1% year-on-year growth is we consider to be a strong performance. And that second half performance across the business we see now as probably the clearest indication of the businesses, of the unlocking of the business and our ability to operate in the new way of working, the new operating business model, in accepting all of the COVID restrictions. And again, it gives us further confidence that we're on track and we've got the right setup to meet our revenue forecasts for 2021. In terms of the cost base, again, reflecting on the profit security measures that we put in place during 2020, we're reporting lower SG&A costs across the different metrics, and an underlying operating profit margin of 7.8%. In a tough year, again, confidence that we are on track to meet our longer term objectives. Looking below operating profit, some of the non-underlying items and the tax items in there, we'll start with non-underlying charges. So the largest one is the amortization of the acquired intangibles. We also had costs associated with the acquisition of Switchback. And then we have ongoing pension-related charges and some reorganisation charges related to the integration of the Coventry and Tadcaster facility into one entity. We're reporting a nil underlying tax charge for the year, so that's been the byproduct of making sure we maximise utilisation of available tax credits. And that tax shield that we've used, whilst it is diminishing as we consume it, it still is a significant amount that we've got access to. So we're unlikely to be making any tax payments in 2021. The underlying tax charge could and will gradually increase over 21, 22 and beyond, but there are still accessible tax credits. And if you could move forward one, please. So on this slide, we're giving an overview of our cash bridge from the beginning of the year, the end of the year, and our working capital position. So we started the year with 18.9 million of cash. EBITDA generated, well, we've been through the income statement, talked about the main drivers there. In terms of working capital, that reduction of 7.5 million, you can see from the box on the left-hand side, it's mainly related to the flush through of projects and the long-term contract balances in our balance sheet. And what we can do to influence that is to make sure lead times are adhered to, the projects progress according to the time plan. We hit milestones, we get project billing at the earliest opportunity, convert that to cash. And that's been one of the success stories, the fact that throughout the organization, top to bottom, we've been focused on working capital management and cash generation, and this is the outcome from that. Moving along the cash bridge, pension payments relate to our commitment to the defined benefit pension schemes. And then CapEx, just pausing and talking about CapEx for a moment. So this includes PPE, investment in business systems, and our new product development expenditure. And Tony had mentioned it was a key part of our strategy to move towards a single entity business model. And a key part of that is to have a blueprint of business systems which we can deploy to all of our units in the group. So that includes ERP, engineering systems, project management systems, commercial systems. And that blueprint, we're coming to the back end of the cycle of investment, and in 2021 we'll be turning our attention to access the efficiency savings and benefits that should come from having that common systems deployed across the group. So that will focus on global supply chain savings, maximising utilisation to adhere to reduce lead times on projects, and also should give us an improved set of management steering tools. So that will be our focus area for 2021. And then the last large column on the cash bridge is the acquisition cash outflows relating to Switchback, and there's a short table in the middle on the left-hand side showing that the initial consideration of 10.2 million less cash on acquisition to the 9.8 million that we're reporting. So in summary there, when we talk about our balance sheet and talk about working capital, we continue to have a high degree of focus in this area. We remain debt-free, we have a strong balance sheet, we're a capital-light business by nature, and that's reflected in a 22% return on operating capital employed. Next slide, please, Hannah. And pensions, I'll give a short update on pensions. One piece of work we've completed in 2020, which is not shown in here, is we've completed the outsourcing of the administration of the UK defined benefit pension scheme. So it's a large scheme with just over 4,000 members, and that was previously an in-house administration team that looked after that. It's by outsourcing, we've de-risked the administration of that scheme, but most importantly, it is a precondition for us to be able to look at other options of how we achieve our eventual goal of decoupling that scheme, to be able to have the administration outsourced and to have all of the documents computerized. So that was an important milestone to get that concluded in 2020. But coming back to the slide, so we're showing an accounting surplus for the UK scheme of 14 million. The deficit on an actuarial basis, well, the last triannual valuation was 2018, so some time ago now. So we're turning our attention and working more on the preparation for the June 2021 triennial valuation, which will be concluded by September 22, but hopefully prior to that. And in the meantime, we've been continuing to work to de-risk the scheme. To do that, well, we've been moving more of the assets into LDIs. We've got 100% of the liabilities covered against inflation risk, and not quite 100%, but a high proportion hedged against discount risk on discount rates. So that's helped shield the scheme from a lot of the volatility that's been experienced by other pension schemes for the last 12 months. And as we go into this next actuarial valuation, of course, it's the opportunity to update the assumptions that will be used, be it mortality tables, be it appropriate discount rates, and part of that will be capturing of the RPI reform, which was on the back of legislation from 2020 that we need to consider. But in summary, it's a well-managed scheme that's under control. It's been de-risked insofar as it can be. And as we go through this next valuation cycle, we'll have in our mind, obviously, that ultimate goal of trying to find the opportunity to decouple the scheme from the company over the medium term. So some final comments on the financials overall. Solid performance in 2020. We've got a strong balance sheet. We're debt-free, we're capital light, we're cash generative, and we have a good quality of earnings under any metrics. We have the access to required funding to meet our long-term strategic goals. So with that, I'll hand you back to Tony.
Yeah, thanks, Will. I think, as we've sort of commented several times here, Mpac has demonstrated really resilient performance over the last 12 months. We ended 2020 with an improved order book, a good pipeline of prospects, which we monitor every month, and we're looking 12 months ahead of ourselves. And those prospects are supplying essential healthcare, food and beverage, which remain robust markets. The first couple of months of 2021 are trading in line with our expectations. So, that's further positivity for us. The markets that we face are inherently robust, and we expect the pandemic to accelerate things like the adoption of automation and the transition to digital technology even further and faster. So I'm really confident that we can deliver on the expectations for the year. Our primary focus remains on organic growth, supplemented by acquisitions, which can broaden our customer reach and provide significant growth opportunities in our chosen markets. And as Will commented before, and I can only reinforce, we're well financed, we've got a strong balance sheet, and represent a compelling investment opportunity for the future. So, with that, thank you for your attention, and we'll turn over to Q&A. Hannah.
Thank you very much to both of you for that presentation. And we have had a number of questions in, so let's make a start. A couple here on acquisitions, both historical ones, so Switchback. Does it have inherently higher margins? And one that sort of looks to the future and the opportunities that you are looking at, and when we can expect any news.
Oh, well, first of all, looking at Switchback, does it have inherently higher margins? I would say not at this moment in time, but that's one of the areas where we expect to grow. The service revenue proportion of Switchback was underweight, lights, and that's an area where we feel as though we can really add value. And to leverage that product into other markets is something that we really want to do. You can see the European one. So we can build up the margin, I think, by being part of Mpac, as opposed to as a small independent company as there was in the past, by offering that as part of full solutions. In terms of our acquisition strategy going forward, we continue the same. We've actually engaged some buy-side advisors a few months ago. Why? Well, we'd run our acquisition pipeline for a couple of years, and we've built up some good relationships, and it's obviously resulted in a couple of acquisitions. But we felt we'd just move the target slightly more into the healthcare markets. So we engaged some buy-side advisors to support that. So we've got a good active pipeline. We are focusing more on the healthcare sector rather than food and beverage, but we're open to other opportunities. And from a regional point of view, we acquired in the USA, which was really important for us, but that's never going to be the overarching consideration. The most important thing for us is the strategic fit. the fact that it would be a good growth company and we can see growth potential, and geography would be second or third on the list. Most of the companies that operate in our space are either in the northeast of the Americas or they're in Northern Europe. So it's highly likely it'd be one or the other. If I had to pick a preference, it would probably be Europe to balance the portfolio a little bit more, but I think strategic fit would overarch any of those considerations.
Thank you. Will, perhaps over to you, sort of continuing on that theme. How much of the second quarter orders generated were down to Switchback, and how much of the year-end order book was in the new was in Switchback and should be stripped out for comparison?
Okay, we'll start with the closing order book. So of that 55.5 million, around 3 million of that order book is related to Switchback. So if you strip that out, then yeah, despite a COVID year, we're still reporting a like-for-like closing order book. So that's covers that one. In terms of order intake from Switchback in 2020, the period from acquisition to the end of the year, their order intake was just around 8 million sterling. So if you can do the maths to see where that leads us to, but it's still, even with that, on a like-for-like basis, there's OE growth second half 20 compared to second half 19, and still a considerable growth compared to the first half of 2020.
Okay. Slightly different question here on your industry 4 strategies. Have you attempted to quantify the opportunity in rolling out these strategies, for example, your automated ecosystem to the 10,000 installed base? For how much of that base is it relevant, and what's the sort of appropriate payback for the customer?
Yeah, it's a complex answer, that one. Out of the 10,000 installed base, you're probably only going back to when we upgraded the HMI, which is the human machine interface, which is the control box that the operator would stand in front of to operate the machine. We did that a couple of years ago in our Langen business. So we're probably looking at a timeline of installations in the last couple of years would be absolutely open to Industry 4.0. And then we'd be looking further back, probably 2 to 5 years, for potentially to upgrade the customer to the latest level of control system, so that they would have access or readily available access to the data from those systems. So it's a stage process depending on the customer's appetite to upgrade their existing equipment. Where we are on the 4.0 journey is we launched some new products last year. They're now being embedded in every quotation we provide to our customers. We're targeting the price of those to be quite modest so that we can get a good installed base, and we've now got activity in that area. One of our key customers, Nestle, we're doing a trial in the UK on one of their facilities, and we're co-developing how the Industry 4.0 product will work for them. So we're still in that sort of learning phase, working with key customers to roll out the solutions and to get their buy-in as to what we can do. So in terms of monetizing that and improving margins, I see that in the sort of 2-3 year horizon from now, rather than immediately today.
Going forward, will you be breaking out the revenue to this installed base and the new customers?
Sorry, Hannah, just somebody was knocking on my door and there was a bit of interference. So what was that question again?
On the back of those strategies, will you be breaking out for investors the revenue between the existing installed base and any new customers that you bring in?
It's not something that we've foreseen, but we will think about going forward, a KPI on how this Industry 4.0 revenues are rolling out, so that we can, pull that out within our presentations. That's, I think, good feedback from the investment community that, let's start to sort of focus in on that, and it helps us as a business. It's part of our monthly KPIs within the business. Will and I review each business on a set of KPIs, and that's one of them. In terms of new product sales based on new products, which that comes into the category of.
Okay, thanks. COVID, as you say, we're probably all getting a little bit sick of it, but have you found that the working practice changes have brought forward the 10% margin target?
Well, what we've shown within the last 12 months is the robustness of our business model, and we've made that sort of, if you like, step change now to, a respectable level of profit, let's say. But being as we are at Mpac, we're never really satisfied, and we want to kick that on to the new level. So we're really embracing the benefits that we've seen from COVID, which is the remote working, the digital technology, and being able to interact with our customer in a more cost-effective way. So absolutely, we want to crystallize that. Me personally, I was on long-haul flights probably once a month, maybe twice a month. I can't see that coming back somehow. I think we will still need to travel to build up initial social equity with our customers. But once you've built the relationship, it can be, I think, adequately maintained in the remote world. So, our travel bill, I'll be looking for Will to keep that locked up and under close control going forward as the unlocking process starts.
You're not missing it, Tony?
I'm not missing it at all, I have to say. It's one of the big upsides of COVID. Jet lag I've not had for a long time.
And then following on to you, Will, just on that point, any working capital changes that you've seen, in terms of all that reduction in travel and other factors? Do you think some of that might reverse over 2021?
Well, our working capital position will unwind in 2021. It was a point in time at the end of the year where working capital reduced by 7.5 million. That is a dynamic position that changes as projects evolve. We've seen in the first months of 2021 that there's been an unwind from the year-end position, but that's a cycle that we've gone through for the last 2 or 3 year ends, where there's been a reduction around Q4 and a wind back up, if you want to call it that, in the early part of the following year. So not COVID related, other than it's dependent upon, to an extent, on the timing of order intake. So insofar as that's driven by, we're influenced by COVID, but it's a knock-on effect, and it's obviously 9 to 12 months on in the cycle.
Well, I think probably everyone on the call would like to know the answer to this one, but dividends, touched on last year, and then events got away from themselves. But what's the board's view on reintroducing dividends at some point?
Well, it's a constant conversation we're having as a board. Each time we look at our earnings, and the prerequisite we said last time was that we've really turned around the business, and I think we can demonstrate, with 2 years good results behind us now that turnaround is complete, and it's not finished in terms of where we want to drive the business. And then the other aspect we said was generating free cash, which we've managed to do as well. So the preconditions are looking good, and it's something that we'll review it, each opportunity with the board.
Okay, thank you. A couple more here on Switchback, a real theme of the questions today. I think someone's saying here, again, looking at the profit margins, they are strong at sort of 17% EBITDA, particularly compared to Mpac, despite a lower service revenue mix and what we assume lower level of complexity of their machines relative to Mpac. So what is driving their margins, and do you indeed believe that there is even upside from here?
Well, we'll probably both have a go at that, the answer to that question, but I think we have to recall who Switchback were pre-acquisition. They were a small entrepreneurial company growing quickly, and they were running really hot and didn't have an awful lot of internal controls that we'd need in a company like Mpac. Now, we're not a bureaucracy by any stretch of the imagination, and I for one fight against governance and regulation as much as I possibly can in the environment we operate in. But Switchback needs some necessary infrastructure and support to be able to grow to the next level. Now, we don't want that to impact on margins. We want to keep them light and nimble, but they were running extremely hot. So I do expect that to be normalized a little bit. Anything you want to add to that, Will?
No, it's spot on, Tony. I think there is further opportunity as we develop the service business in Switchback. So the level of margin that's been quoted is based on the existing model, but there is opportunity in the future years.
Okay, sticking with Switchback, ready to drink market in the US is worth about 5.8 billion. There's also a huge shortage in the canning capacity in the UK and the craft spirits sector. Is Switchback seeing any interests from customers in those areas?
Yeah, the Switchback isn't just a single play in craft beer. I know that's the one we focused on, and because that's been a really strong market, but they are, the product are equally applicable in healthcare, in other foods, and that's where we want to really leverage them. The US market is also evolving, and one of the strong growths is wine in cans as well. I'm not sure that'll take off quite as quickly in Europe, maybe, or maybe not, but certainly other drinks that are coming in cans is an area. It's down to volume. Why it hits the sweet spot with craft beer is because of the environment in which a lot of craft breweries operate, and that's fits very nicely to the Switchback business model.
Okay, I think wine in cans might have missed its moment on the park bench in the last 3 months. Is the underlying EPS after an assumed normal corporation tax charge, Will? And what is the status? Sorry, I'll add this on. What is the status of the land in the southeast of England for which you're seeking residential planning?
Okay. So the reported EPS is with the actual underlying tax charge rather than the normalised effect. If you consider normalised tax charge, perhaps that would take 3-4p off the reported underlying EPS. And in terms of the land in Buckinghamshire, the status of the development or the application wasn't accepted last year. There's been no further changes in that status. Should we say it remains on our radar, and at the first opportunity to make another application and to appeal against that, we will do, but it's not something that we are investing time or energy at the moment. We're focusing on the core business. Okay.
I perhaps last one here. I'm conscious of time, but perhaps just one to finish up on in terms of the competitive environment and any additional comments you can make.
Yeah, the competitive environment is mixed and varied, as I think I've commented before. There are different sort of, if you like, stratas of competitors. There are a small number of international large players in the €1 billion, pounds, dollars space. A company called Mpac in the Americas has come really into prominence over the last couple of years with their private equity backed cash reserves to be able to acquire. I think they're now 40-something companies that they've acquired to create a really huge packaging machinery group. Syntegon is the other one, which used to be Bosch Packaging, which was bought by private equity about 3 years ago now, and they're going through that reorganization. So they've got their challenges, in fact, of it's not easy to do these sort of reorganizations. So that, I think, is an opportunity. In our space, there is a lot of consolidation going on, and there is, again, a lot of private equity money. And we were, I think, in a very good competitive position because we invested before COVID in a lot of group infrastructure projects and connectivity projects, IT, and that held us in good stead. So we're in that central tier, and I think we're really well positioned with what we're doing in terms of building the brand and being able to offer customers full solution alternatives against some of the bigger competitors. And then there's a tier below that, which is they call in the USA the mom and pop shops, which is where you've got the entrepreneurial small companies, probably 20 to 50 people, a strong commercial person, a strong technical person. They're the people who are pioneers in certain markets, a la the Switchback opportunity that we've managed to acquire. So it's a mixed and varied, but I think Mpac is really well positioned. We've got the agility of a small company, but a lot of the structure and approach to our customers of a bigger company.
Well, thank you to you both. We have got a couple of comments here on terms of forecasts for both revenue and PBT and EVS growth, and I would encourage you all to go and have a look at the research note that we published this morning, which has forecasts out to 2024, I think. So you will find everything you want there in terms of forecasts. Obviously, those are equity developments, not the companies, but should give you a reasonable guidance on where we think they're going. So that just leaves me to say thank you all for attending, and gentlemen, thank you very much for your presentation today.
Yeah, thank you, everybody.
Thank you.
Speak to you soon. Bye-bye.